Hello, ladies and gentlemen. Hello, everyone, and welcome to this afternoon webinar. How's everyone doing today? I hope you guys have a great time so far. Busy trading activity, I assume, for everyone here. So before I introduce you to Mr. Jens, your host for today, allow me just to let you know that here at Admirals, we have the YouTube channel. That's where we put all the recording webinars. So I will share with you guys the link. Just give me a sec to bring up the chart. Oh, Doreggi. Hello, I remember you from the morning webinars. So how is trading going so far, Dorel? Did you took some good trades? It was a lot of opportunity as we discussed today on the live trading morning webinar. So here is the YouTube channel, guys. Please make sure you subscribe, you active the bell button, you receive notifications when we upload videos. It will be great. And also you can give us thumbs up on the videos. We appreciate it. You can follow us on the Instagram, and I highly suggest you and encourage you to do that, because on the Instagram, we put reels, we put nice education content in terms of theatric, let's say, some things, and also the 30-second market updates we put here. It's really valuable for yourself. Also, when Jens will host the webinar, it always gives you a good brief introduction. And the Telegram channel, you will get notification when we post articles on especially on the website, so you never missed anything. And something really, guys, I would like you to keep up and start using from now on. Here at the website of Admirals, we have the analytic portals, weekly trading podcast. And here, please make sure you engage yourself every Monday. I record and upload the market events for the week, so you know what kind of events they're gonna be in focus during the week, and you will be able to anticipate some moves. So you can use my experience in this type of analysis for your own best interest. All right. So I will share this with you. Feel free to download the podcast on your devices, or you can play them from here. Either way is fine. So, Mr. Jens, hello. It's our honor and pleasure to have you here with us today.
Thanks for having me, Theo. How are you?
I'm very well, mate. Very well. Thank you. Here, busy with the obligations. Now we are doing the Investors for Beginners course, so it occupies a lot of my time, but it's going to be really valuable and great tool for our traders, for our participants. So
which investments do you recommend?
I recommend. I'm still bullish on the tech. On the tech stocks.
Oh, you are. So then Tesla is a bargain for you right now.
Yeah, absolutely.
That's good to hear.
I
One
like
second,
Netflix.
please.
I like.
1 second. I just have to buy some shares. Wait a second.
Okay. How are you doing? How are the markets doing this afternoon?
I think it will be a very fascinating trading day, to be honest. So in the morning, I woke up with a big grin on my face, because I read the headlines that there's now some questions in regards to national security stuff, and the Twitter Musk acquisition, and so this could in fact be very interesting for Tesla, especially with this very important region around 200 USD, I think.
Oh yeah.
So if we break below that, because now national security is not an issue anymore, or at least at first, and then we see a flush lower, but then we see Biden stepping up and saying, no, my friend Elon Musk is not going to buy Twitter. We see a sharp reversal. I mean, yeah, it's fascinating. A snap yesterday with earnings after hours. So I think it will be a very, very fascinating trading day today.
Okay, so stage is yours.
Yes, wait a second. I have to share my screen. So, and now the interesting thing is we won't talk about US equities today, at least not now, but we will talk about the ECB next week with a very and highly anticipated event, in fact. The interesting thing is, I think it will be, as have been the last, let's say, times, months, probably years, will be very pathological. I think it's not as clear the monetary policy path the ECB follows here as from the Fed. So we've done this in the past around formulating a trade hypothesis for the Fed, what to expect, and rate hikes. So I think this is also something we should keep in mind here, even though the ECB is massively lagging here. And by the way, let me just say a hello here in the chat box. Hello, traders. So this is where you can ask all your questions. And so yeah, the ECB is lagging, in fact, and inflation is getting out of control. And even if we see another rate hike now of 75 basis points, not really sure whether this is really something which is sustainable. First, this is the first thing, because with all the volatility we should expect in bond markets, especially Italian yields here, and therefore we just have to look over to what's happening in the UK right now with the resignation of Liz Truss after the U-turn after her announcement around taxes and everything. So given that, I think it's very pathological, but we try to, or I try to guide you through my thought process here, which assets to focus on then next week in anticipation of the ECB, which levels to watch, and then use these to formulate a game plan and to take it from there. So I think, as usual, I don't need to introduce admirals anymore, because Theo has done so already in the minutes before. So that brings us, in fact, quite straight and direct here to today's agenda. And in fact, I haven't prepared any kind of text or graphics or something like that. But what we want to do is we want to go through the charts and use these and answer these bullet points here, these questions. So how the ECB rate decision will affect global financial markets, what to expect, in fact. Therefore, we will head over to the Forex calendar you can find on the website from Admirals. I will share the link in the chat box here within this event. And then we will answer the question how this affects the DAX and EURUSD. These are the two main markets I will focus on, even though I'd really appreciate it if you ask your questions in regards to assets you're watching. And first of all, we will see, will it really affect, will the asset you want to give a look at, will it be affected by the ECB rate decision, like let's say gold or Bitcoin? Why there's a probability that it is affecting this asset then in this case, or if it's not, and why it's not. Also where I then take it from there and we game plan around this. So give it an overview, where do we stand, and then have a look here at how this ECB event could affect the market and which levels to watch if we break higher, lower, whatever. And then, yeah, certainly this is in fact, directly pointing to the third bullet point here, how we could formulate a game plan, how we could formulate a trade hypothesis here around this game plan, what to expect, and then formulate several scenarios saying, okay, if A, then B, if you want to put it that way, give it a certain, let's say, probability. If let's say a rate hike of 75 basis points, I currently give it a probability of, let's say, 75% to 80% probably. Then there is a lower than expected rate hike, let's say probability of 10% and probably 100 basis points, a little more hawkish, we are at another 10% in fact. And then we take these, even if they have a low probability, look at the assets. We should expect to see the most volatility from the ECB decision from, and then formulate a game plan around this. So let's say they come up very dovish, let's say less than 75 basis points, come in at 50 basis points. What does this mean for the Euro USD? Well, usually, or for the Euro in general, usually we should expect Euro to drop on this news, respectively the DAX popping higher because it's a less restrictive monetary policy path we follow there. That being said, that means less restrictive monetary policy, which is usually bullish for equities and bearish for the underlying currency. So now let's jump over here to the wait a second. Let's jump over here to the chart, and I have the Euro USD here open. Let me just, by the way, check the chat box right here if everything's cool. So yeah, if there's any questions, again, if there's any questions, please feel free to ask them right in the chat box. Okay, so first of all, well, probably we shouldn't start with the chart, but we should probably start with the economic calendar first, and where to spot these highly anticipated news events, in fact, and how to find that. We went through this already in the recent past. In fact, we gave this deeper look here in one of the most recent events, I think 2 weeks ago. Last week we had, no, 3 weeks ago, I think. 2 weeks ago we had the NFPs, if I'm not mistaken. Whatever. So what do? Is I go to admiralmarkets.com, the website, then I head over here to analytics. There's the Forex calendar. And then what I do is here you can see, I can, first of all, look at the data range I want to keep an eye on. So therefore, I refresh this. I did this already here before we started the event. And here, in addition to that, you can also filter which currencies you want to have a look at. So first of all, we know that there's the ECB taking place, but at first glance, it makes probably sense to check all boxes here with the G7, probably even the G8 in this case, and take in also New Zealand here into account with all the most relevant economies here and their currencies, and then we apply the filter. You can now see we have here kind of a rainbow, let's say. So with all events, like the ones which don't have such a high impact on the markets, a medium impact, and the high impact. So probably makes sense to really filter this with the most and highly having the most and the highest impact on the currency markets. And so then I apply the filter. I checked also this box, and now you can see this is the overview of the next week. And what you can see is that next week, it's not just the ECB. We'll look at the ECB because this is affecting one of the most traded currencies of all, let's say, the most and the most liquid one. It's the Euro USD here in this case, but we could also give the BOC, for example, a look here. So on Wednesday, we have the Bank of Canada with their rate decision. Also very interesting. You can see previous 3.25. So they're expected to hike by 50 basis points then in this case. That's going to be interesting because we should remember I think it was 3 weeks ago, no? I think so. I think it was the 3rd or the 4th of October when the Reserve Bank of Australia gave their decision around rates here, and they hiked by only 50 basis points, and they were expected to hike by 75. So that was one of the reasons why we started quite bullish into the quarter. That was one of the, in fact, most bullish starts in equities, especially into a quarter since, I think, was the most bullish start into quarter since 1938, if I'm not mistaken. And why do I make this a topic? Because we shouldn't underestimate in the current environment, especially that around the globe, central banks, given the economic downturn we can face and potentially inflation topping out a little, that they're probably giving their monetary policy approach a more looser, let's say a looser touch in this context. So this is definitely something we should keep an eye on and keep in mind when it comes to the rate decision from the ECB, which we'll cover today, which will be next week on Thursday. You can see there, previous 1.25%, and we are now expecting to come out at 2%. What does this mean? That means that we expect a rate hike of 75 basis points, or 0.75. And this is what we should expect and where we build our thesis on. So now the interesting thing is now coming here into what comes into play. Why does it is of such high interest, especially if we see such a, let's call it, restrictive monetary policy approach? Well, because it directly affects the yield markets. You probably have seen the most recent downturn. Probably we should also bring this in here. One second. Let me just here take the symbols. And so what we will do now is we will look at FGBL. Does it work? No. Okay, then try it that way. Try it with Bund. There we go. So you can see here the Bund, which is the 10-year German yield, in fact, respectively the future. And what we also will do is we will have a look here at the so-called TLT. This is an ETF, in fact, which covers 20-year plus treasury bonds in this case. And we'll also have a look here at this. And then we'll go over here. So this is Tesla, by the way. We will have the Bund here. And we will have here the TLT. So, one sec, please. Let's do it that way. So, probably I should give it TLT.US, and it's a daily chart. And we have the Bund here. So why is this of importance? What we currently face here. So it's I call this FGBL. So this is the future equivalent here. So this is German Bunds for 10 years. So why is this of importance? Well, it's of importance because you can see that there is a clear and very strong downtrend currently. Why is this interesting in the current environment? Well, because if you see a downtrend here in yields, respectively, this is not yields, but it's I'm sorry, what's the English word for this? One second. Let me just give it a look here. So the German word is Anleihe. Let me just see. It's bond. Yeah, sure. I'm sorry. Bond. So it's Bunds. It's the bond, the German bond on 10 years here. And you have a negative or an inverse correlation between yields and the quotes here, respectively, the bond in general. So that means if yields rise, which is currently the case given rising inflation expectations, well, you expect the market here to drop and the market to pay a higher yield for the underlying bond, which we are looking at here. So this is very interesting because you can already see we are coming from a quite elevated level here. So we topped out around 178 or something, and that was, I think it was very close to minus 1.1%, minus 1.5. I'm not really sure, but we are deep negative territory here. So you had to pay if you held German bunds in your portfolio, and from there we sharply dropped. And right now we see the highest yield levels here in German bunds since 2011, if I'm not mistaken. I think that these are the highest levels and above 2% now for 10 years since 2011, and the height of the Euro financial crisis. You probably remember that. So why is that of importance? Well, because if German yields are rising that aggressively, you definitely expect the same and even more than that to happen in terms of Italian yields, for example. So therefore, I head over here to the website, which is called tradingeconomics.com. And I have the balance sheet here. So this is the explosion of the balance sheet. So yields dropped that aggressively over the course of the last 10 years, given the massive monetary stimulus we could see from the ECB. So you see here the explosion of the balance sheet. We're coming from around 2 trillion euro, and we nearly quadrupled that, and even more than that here post the QE, which was launched with the whatever it takes from Mario Draghi in well, we could foresee it, we could see it coming, let's say. He talked about this in April 2014, in July 2014 in London, and then we launched QE at the beginning of 2015, and then we topped out here. So there was no more aggressive monetary stimulus taking place within a period of, I'm not really sure. I think they aggressively continued to buy, but you see here that they stalled out. So they were starting to roll their expiring bonds within their portfolio and trying not to expand the balance sheet even further. And then we saw another explosion here on the upside around COVID and all the developments around this fiscal stimulus being or debt, which was monetized by the ECB, so on and so forth. We saw the same with the Fed balance sheet, for example. And so that being said, we can now see with inflation picking aggressively up why rising rates are a problem here, because now you have all the debt and you can't afford taking on more debt. And this is getting a problem, especially for Germany, beside the energy crisis and the economic downturn and the recession forming. But this is especially true for Southern European member states in the southern periphery. So therefore we go over here to countries, and then we click on, let's just take out Italy here as an example. We won't look at Spain. There's a little different development taking place right now, but we have a look here. We look at the government debt to GDP ratio. In fact, government spending debt to GDP is there. You can see it's around 151%. So these are the same levels as we've seen with Greece, that was at the beginning of the European debt crisis around 10 years ago, and the starting point. And we already saw some massive tensions here forming around the euro as a whole. So now we can see that there is a similar development post, especially here COVID, with an explosion in debt terms. And well, the main reason why, let's go over here to, one sec, let's go back to, let me just think about this a while. Is it prices? I'm not really sure. Overview, probably it's yield. Let's see. Let's have a look. Interest rates. No, this is an ECB level. Where do we get this? Let me just think about this. Prices, labor, health, probably money. Interbank rate. So if this is not cutting it, then we do something different. Okay, let's do it a different way. One second. Let me just here get I'll do it that way. So let's just here use a trading view in this case, and I want to show you the yields. 10 Italian. I don't want to have a look at shares. Yields. Do we have it here? ET yields. ET10, probably. Yeah, there we go. Government bond yields. So I go over here to a daily chart, and then you can see here a very strong trend on the upside. You can see that we started to really drop aggressively post the launch of QE here. So in fact, when Draghi talked about this, you remember, look at the timestamp here. So this is July 12th, 2012. That was already the start, the height of the European debt crisis, and you could see and the rhetoric being used from the, I think it was, by the way, I'm sorry, I was wrong. It was 2012. It wasn't, there was the announcement, we'll do whatever it takes. That was in 2012, but they launched QE in 2015. I'm sorry, I had this wrong, but whatever. So what we could see is we topped out around at 6.5 around here. And from there, yields were driven aggressively lower here. And you could see that we really bottom out at 1%. The only reason why market participants didn't want to own or why they wanted to own Italian debt here was they knew there is a lender of last resort right now coming into play with the European Central Bank, and they are buying whatever it takes and to keep the euro alive. Then you saw some spikes. These were some political headlines, and right now this is not just political developments, but this is also inflation aggressively picking up, beside the fact that the ECB said, well, we will stop our QE because we have to fight inflation now. And now you see yields shooting aggressively higher. And you can see that here, for example, in Italian bonds, 10-year Italian bonds, we are already at nearly 5%. So the differential between German yields around 2% and Italian bonds is around 300 basis points. So this means 3 percentage points here higher. And that being said, given this development around the coming back here to the GDP, debt to GDP, 1 second, where do you have it? Government, I'm sorry, government debt to GDP of over 150%. And given the economic downturn, energy prices exploding, well, you can't really hike rates more aggressive then we're probably already at a point where it's too aggressive. So why do I mention all this? Why is this noteworthy? Well, this is noteworthy because we now see, let me just take this back, by the way, because we know that the Fed has limited potential on the upside. So this is what I mean when I say something like a pathological path they are following. Because the thing is that you don't expect the ECB to come out with more than 75 basis points. If they come out with 75, you know, there is not much room on the upside anymore if they want to keep the euro together, let's say, and won't see Italian debt not just exploding, but the overall Italian government imploding, in fact, and defaulting on their debt in this case, and seeing a complete collapse of the Italian economy. So that being said, putting all this together leaves you with limited restrictive rhetoric here in this case. So, and if you now have a look here at the EURUSD in this context, what you can clearly see is that we are forming a clear downtrend. That the reason for that is because the backbone of the euro in general has been Germany, is Germany, and the let's call it the business model is Germany and the economic strength of Germany. Once we head into a recession, which we're currently facing, the euro is about to collapse, in fact. So this is there's a very rough story, but this is just how things go. So, and the question which arose around 10 years ago when everything was fine in Germany and the economy was booming, thanks to the low interest yield levels, and everyone was making money. In fact, over here in Germany, and again, the economy was booming, so the euro was stable, and Germany was capable of holding the euro together. And well, this is now falling apart, as is the euro right now, and it's falling even quicker apart, let's say, once we see a too restrictive ECB. Next week on Thursday. So having that in mind, by the way, one second, please. I just have to write down some notes for the US equities trading today. So I just mentioned it at the beginning that I have two shares on my radar. It's first it's Snap after yesterday's earnings, and I have Tesla on my radar. And I have to write down some key aspects here for my trading, because if I review my trading, then afterwards I need those key parameters to get a clear overview of what I was looking for. And we understand, therefore, I especially need the pre-market volume. So in case of Snap, it's how much do we have here? Wow, over 20 million. In case of Tesla, it's over 2 million. And this is something I just have to write down, 2.6. And then I also have to make sure that I have the gap lower, even though in case of Tesla, the interesting thing is that I'm not really looking at the gap here, but I'm looking at the key technical key level at 200. So that being said, let's come back to the ECB and how to play, in fact, Euro USD in this environment. So you can clearly see here that we start to kind of forming a bottom, let's say. So you can clearly see that we are not sharply selling lower here after hitting an extreme around 95, and now especially with the Fed potentially, and the reason for this aggressive downtrend forming here, the main macro driver has been that the yield differential between Europe and the US, respectively the Fed and the ECB, was divergent that aggressively. So it was just way more attractive to buy USD than holding euro, because you have a higher yield, beside the fact that you have the world reserve currency, and there's a strong demand for USD right now in terms of energy and the explosion in energy prices, and you need USD to buy, let's say, a barrel of oil, simply speaking. And so that being, or that having this in mind, explains the macro driver lower here. Now the interesting thing is, we are expecting the Fed to hike rates, the ECB to hike rates by 75 basis points. And this is nearly baked in because everyone is expecting this right now. But the interesting thing is that the Fed won't necessarily follow as aggressively. Probably they will hike rates by 75% in November, and then again 75 basis points also in December. But the rhetoric will be probably more balanced, let's say, or looser, let's say. Probably that's a better way to put it. So having this in mind means that we are probably, by the way, just see here. So that means, in this context, that we are probably about to trade within a range, let's say, and the only really potential I see on the downside is as low as, let's say, 96. So I could imagine that we are probably ranging here within that area between 99, respectively, probably parity on the upside, and 95 on the downside. So I don't really expect the market to break out here, even though given here this current structure, I could imagine that there's probably a short flush lower, but then we are trading higher and pushing back towards parity. So that's my current expectation, in fact, and then how I would play this. You can see here already that the overall environment in which we find ourselves is very, very unattractive. So it's range bound. It's not really clear in which direction we will break out, even though right now the most I see on the downside is potentially a flush lower, but then a push higher, which is especially true if it's a neutral stance. So you get the 75 basis points, and then you get a rhetoric, which is just a little, let's call it blah, blah around. So it's like what we've seen from Ms. Lagarde for the last months, in fact, or last time we saw the journalist asking questions, and then Ms. Lagarde giving an expectation, or what to expect, let's say, in the upcoming months, in fact. So it was very like, how can I say that? Yeah, and in German we call this monotone. So it's like there wasn't something special about this. Let's put it that way. So that it was really like there was no clear outlook to what expect, in fact. And having that in mind, it's quite, let's say, it's quite this neutral stance alone, and given the fact that most of this yield differential and is baked into the price, let's put it that way, gives us a chance that the most we should expect is a flush lower and then a pop higher into parity on the upside. Well, not necessarily a pop here, but a trend probably forming up to these levels. Very, very negative. What would be very, very negative would be if we only get 50 basis points, because this then is in comparison very dovish to what to expect from the Fed and the 75 basis points in November and respectively in December, then 6 weeks later. So that being said, here gives us a clear outlook, in fact, that we should expect at most the flush lower, but then a trend higher. So this is what I expect for the Euro USD and this environment. What do we get to see, or what should we expect in terms of the DAX for such an environment? I'm not even sure if the DAX will see any kind of sharper reaction to the ECB in general. If we get to see a reaction, given the overall environment in which we find ourselves in, I consider the DAX, in fact, compared to US equities right now, to be kind of, let's say, relatively strong. That's probably a good way to put it. So given the fact that, let's just head over here to the S&P 500. So having a look here. So, and then you see that last week we made new 52-week lows. That was after the US CPI data came out at 8.2%. We had inflation already, a topic last week. And then we flushed lower and pushed higher from there. Right now, trading still here at a, let's say, solid level, solidly above these extreme lows to 52-week lows. But given what we see here in the DAX, I have to admit, this is relatively strong and way above new 52-week lows, respectively here. If we look at that was at the beginning of October, in fact. So the flush lower, you can see it here. That was let's call it the CPI flush here. We didn't make new lows. This is a sign of relative strength, personally, I think. And that being said, leaves me come to the conclusion that, especially if we get a more neutral stance in the overall expectation around the Fed, I shouldn't really, or we shouldn't really see more bearishness, but more like a drive higher and probably even a push above 13,000. That's even more true if the ECB comes out more dovish and only with 50 basis points. Again, in my scenario, in my game plan, that's a scenario which I only have for around, let's say, 10%. I don't really see the ECB hiking by only 50 basis points. Yeah, and so in fact that's it around the DAX and what to expect for the DAX in this environment. Are there any markets? I just ask directly here. Are there any markets you have on the radar and you wanna get an outlook on? Or probably first of all the question: is there a market where you're not really certain whether it will be affected by the ECB rate decision? And if it is, then that we then game plan it. Is there any market you are or which is of high interest for you? Probably I already anticipate before I get now here a response in the chat box. I head over already here to gold. Is gold potentially affected by the ECB rate decision? I'd say the clear answer from my end is no, not really. I don't think that here the ECB plays overall a major role, if at all. In fact, what's of interest for gold is what we can expect from the Fed, and given the most recent run lower here and now holding, at least for now, holding here. The yearly lows around 1,610 USD. I would say if we get some kind, if we get some kind of dovishness in the statement or a neutral stance, this could then probably lead here to a more, let's say, dovish response or dovish expectation from the Fed at the beginning of November. So in fact, next week on Thursday, we have the ECB The week after that, on the 2nd of November, we have the Fed with their rate decision. And what we currently saw, especially when looking at US equity markets, is certainly a clear push lower due to recession fears, inflation kicking in, big tech coming under pressure, and so on and so forth. And one major driver, and we've seen that in several earnings releases now in the recent past, was certainly that there was a clear point towards a too strong USD. So if we now get a neutral stance from the ECB, and here in this context, then especially euro, let's say, picking up to some extent and pushing back towards parity, probably there's a hint, there's a trend forming which drives us up to and above parity, and to some extent a weakening US dollar that might let the Fed come to the conclusion, or probably add some fire to the fuel, that they say, well, we go by, in this case, 75 basis points as expected, but don't expect us to hike another 75 basis points in December. Or expect us probably to be more neutral, let's say, and don't do anything at all in the first half of 2023. This could really drive the US dollar aggressively lower, and not really affecting the overall expectation in terms of inflation in the US, but it could really affect the outlook for the upcoming earnings releases, upcoming earnings seasons, probably the US economy in general. And in this context, not just that, but driven by, that's probably a better way to put it, mainly driven by the US dollar losing some momentum here on the downside. So this is definitely something to keep an eye on. By the way, I just have to here give this a look. So probably Tesla is not pushing lower. That's very interesting. But Snap is now breaking two new intraday lows. So this is very interesting. So Snap is potentially a drive for the downside. So I have this here on my radar. But coming back to the Euro USD in this case. So that being said, it could be interesting to see how the ECB handles this potential. Well, how can we say that? Risk. The risk here of a too strong euro. So right now, they don't really consider this to be a risk. So usually you say a weaker euro is good for especially the southern periphery here. And thus you don't have any issues. You don't have a real problem with seeing the euro losing ground towards the US dollar, even though in the current environment you also import inflation in such an environment. That having in mind, you probably find, at least for now, to see a slightly stronger euro towards the USD. And if we combine this, then this thesis here around a bounce back to and probably even above parity becomes even more interesting. And it's probably something we don't really need a very, let's say, we don't really need a policy or a monetary policy decision from the ECB, which massively diverges from what's currently expected, in fact. Yeah, what else? So we have gold, we have the Euro USD, we have the DAX. What about Bitcoin? Is Bitcoin potentially affected by the ECB rate decision? What do you think? I'd say not at all. Similar to gold. So here, market participants clearly watch let me just see. Yeah, clearly watch what happens in regards to the US dollar, what happens in regards to the Fed. You can see here we have no real true volatility, let's call it. So we are trading. You can already clearly see it here in this area. Even in the lower time frames, you don't really see any trend developing or something like that. So it's range bound. range bound in a tight range, in fact. So on the downside, probably we can go as low as 18,000, probably slightly above that, 18,200. On the upside, we have 20,500, which is, by the way, my key level. So in fact, and the longer I think about this, and when I put all these puzzle pieces together, I see Bitcoin, if there is a breakout, if it will happen rather sooner or later, somewhere in the future, I see the breakout on the upside, and I see the run above 20,500, and probably even a drive then here towards 22,500, probably even above that level, 25,000. But really have to wait, and we won't get to see such a break out of this range. Let's say 18,200 on the downside, 20,500 on the upside. We won't see this from or initiated from the ECB rate decision, but we will see that initiated here from the Fed and their take on yields especially. And if there's any kind of like we are now at the or within the upper range of what we are willing to hike rates to combat inflation here. This could be then a driver, especially for tech titles, to bottoming out and then really pushing higher. Respectively, the US dollar then in this environment really pushing aggressively up from there, and where respectively selling off, where dropping more aggressively, equities pushing up, US dollar coming under pressure, and thus pushing Bitcoin higher in this environment. But the ECB won't really affect here the developments, even though we should keep in mind one currency pair, which is currently really completely getting out of control on the upside. It's dollar JPY. We are currently seeing here, as you can see, the push up to 200 and 150 and even beyond that level. And the question is, how far will the BOJ let the JPY devalue here before aggressively intervening? And I think the answer to this is we are getting closer to a point where there will be an intervention from the BOJ. What can the BOJ do? Well, they could hike rates, but this is not an option since they ruled out hiking rates already in April this year, and really doubling down on their QE and their respectively their QQE, quantitative and qualitative easing. I'm sorry, quantitative easing. So what we should keep in mind is that Japan is the biggest creditor of US debts, which means they could really aggressively and sharply drive USD lower in this environment. So you don't really need the Fed to step in and be more loose with a monetary policy approach. We could probably, at least short term, expect weaker US dollar given a more restrictive monetary policy. I'm sorry, not monetary policy approach, but a fight to see to stop the devaluation of the JPY. From the Bank of Japan by selling aggressively US dollar here into the market, which would then also result not just in a USD JPY, similar to what we've seen here at the end of September with this spike lower from 145 down to 140. That was shortly after there was this announcement from the BOJ that there will be stealth interventions, they call this. We could see also a sharp drop here lower, which is, by the way, also certainly then a driver higher for the euro back towards parity, but also US dollar lower, which means like a sharper bounce in gold we should expect. But you can see this is something which is not affected from the ECB rate decision. So the ECB plays its own game right now. So in fact, it's like everyone is watching the Fed. What will the Fed deliver? And we shouldn't expect too much from the ECB because they're really standing with their back towards the wall. So they can't be more restricted than they are. They probably are right now more restricted than they want to be, given the debt situation in the southern periphery. That being said, expect 75 basis points, expect a neutral stance in terms of the rhetoric, given the overall development and most of this being baked into the price. Right now, I'd say, well, we are probably more likely to see a push back towards parity, even though I don't really see EURUSD sustainably regaining parity here, or recapturing parity, the level, but see a range bound trading within 95 to 1 here over the next 6 to 12 months, probably that's a fair way to put it. And so that's it from my end. Let me just here finish with this. I'm sorry, I want to have this one. No, doesn't work. Let's try it again. There we go. So these are the contact details from Admirals. If you liked the webinar, please feel free to check out Admirals for questions you might have, for feedback. If you like this, you're watching the recording on YouTube, please leave a thumb up here, a comment in the chat box below, subscribe to the YouTube channel. So that's it from my end. If you take something out of this, please be aware and remember that this is a purely educational webinar. So if you take now any trades based on my thoughts, you take the full responsibility and risk yourself. So this is the risk disclaimer. Please read it carefully, and see you next week. So that's it from my end. I wish you all the best. Have a nice weekend. Enjoy yourself. Talk to you again next Friday. See you. Bye-bye.